Well, I began my career as a stockbroker, and then I moved into the field of trading as a market maker. I then moved into the field of corporate finance as an investment banker, and I now spend my time consulting, and I consult in three main areas. Those three main areas are, as I said earlier, I'm in the midst of a roadshow going up and down the UK, helping students and graduates secure careers in these really ultra-competitive, tough times that we actually face today. The second thing that I consult on is I consult at financial institutions on trading and investing strategies. And the third thing I consult on, which is what the topic of what we're going to cover today, is the financial crisis. Now, I personally think that the financial crisis is just about one of the most misreported and misunderstood topics that there is out there. What you'll find at the moment, if you read any newspaper or you switch on any TV, and if you look at any speech by any member of the government or any member of the Bank of England, is you'll find a whole lot of what I call management by crisis. There's a crisis, they're trying to figure out what they need to do, they have an idea, they implement it, and hopefully something will happen. Well, what I would like to demonstrate here for you today is that I would like, just for the next hour, for you to do me the honour of completely forgetting everything that you've been reading and to completely open your mind, just for the next hour, to a completely new possibility. Now, what most people are focusing on in the newspapers and the press is what I call symptoms. Symptoms of a greater disease. I like to use the analogy of a body. Most people, they wait until their body actually collapses, until they actually do something about it, and they tend to take a series of, they have some operations, or they take some drugs, or they do whatever it is in order to fix the symptoms that appear. When very few people actually focus on prevention, staying healthy, eating the right things, whatever it may be, creating a sustainable body. Well, this is exactly what I see happening at the moment. Everybody is focusing on the symptoms of what I call unsustainable economics. Unsustainable economics, which I'd like to show you and demonstrate to you today, which has been built up over years and years and years, and is not unique to any government or any party, or in fact this has been built up on theories that have been taught for decades, if not centuries. And I would like to demonstrate to you today that we are in an unsustainable economy, but what we're seeing right now is symptoms of that. And if we treat the symptoms, we're only going to go for a short-term measure. What is actually needed is recognizing the sustainability of the economy that we actually are in today and actually doing something to achieve that sustainability. And I'm going to point you in the directions of some of the things that we can actually do. But before that, I really need to lay the foundation. And I present this an awful lot at financial institutions. I'm a part of a sustainable economics group, and I present this to government agencies and students interested in the banking and finance sector, and economics professors and economics students. And I need to begin really with the same beginning, really. And that's to really open your minds to a completely new possibility. So what I would like for the next hour is us to ask questions different to what everybody else will be asking, and to see things completely differently. And just for the next hour to forget about these things called greedy CEOs and horrible investment bankers and these terrible hedge fund managers, all symptoms of the disease, as it were. And that we've spent over and beyond our means, and we've got to forget about all these things and actually start to look at the structure of our economy and the economy that we actually live in today and what we have built up over periods of years, decades, centuries. So, in order to get everybody on the same page, I would like to ask a few questions. And the first question I like to ask is, does anyone in the room actually know how money is actually created? Does anybody have any ideas how money is actually created?
It depends what kind of money you're talking about.
Mm-hmm.
Because you can have banknotes,
Yeah.
bunch of money,
Yeah.
and you can have all sorts of money.
Mm-hmm.
Goods and services.
Mm-hmm.
So
Okay.
you just need to
Can I ask your name? Valeri?
Valeri.
Valeri? Those who didn't hear, Valeri just said it depends what type of money you're referring to. You could have banknotes, you could have coins, you could have goods and services. Depends what type of money you're referring to, which is a good answer. Has anyone got any other ideas about, let's focus on, say, banknotes, money that we actually spend, money in our pocket, money that we actually spend on our CFA student fees. Anyone got any ideas how that money comes into existence?
Generally, you having like, you know, the amount of goods and services.
Mm-hmm.
You probably divide them by the quotation, and that will give you the amount of the money you have. And if we're talking about, you know, like cash,
Okay.
you have a nation.
Mm-hmm. Okay. Well, what most people tend to answer this question to is that they believe that the Bank of England creates the money. That's what most people tend to say when we do this. And I tend to demonstrate to them that pretty much every single penny, pretty much, and I'll show you the exceptions to that, that comes into existence is created through debt. Is created through debt. And in fact, the Bank of England doesn't just give money to people or give money to the government to spend. Almost all money is created via a debt. Via a debt. So what does that actually mean? Well, let's have a look at this question. I'd like to show you, if the Bank of England creates all the money via debt, I'd like us just to think about the following process. Imagine all money in existence has actually been created through debt. If it's been created through debt, then let's ask the following question. All the money has been created, but with debt, there's an addition to that debt. The addition is that you need to repay that debt plus interest. Does that make sense to everybody? Every piece of debt that we take on is to be repaid plus interest. So I would like to ask right now, if all the money that we have in our economy is created into existence through debt, then where does the money come from to actually pay the interest? The World Bank, this gentleman says. Anyone got any other ideas?
We're talking about the money multiplier, where the depositors deposit in the bank and then the bank loans out to other people, so that way it creates money.
Okay, this gentleman says the money multiplier, which we're actually going to dig into the assumptions of the money multiplier today, so thank you for bringing that up. Well, the answer is that a lot of people at this point, they also say tax as well. Well, surely we pay for it through tax. But that tax is just part of this money supply to begin with. The answer is that the interest cannot be repaid because the money has not been created in order to repay that interest. So let's have a look what that actually means. Let's have a look at this chart here of the UK. I've taken a snapshot of money in the UK. Now these terms, anyone heard of these terms? M0, M4? Whether you understand them or not, has anyone heard of them before? If you could raise your hand. Yeah, that's exactly that. Well, these terms, which have come, well, common language that we're referring to at the moment, have a lot of confusion behind them. But they refer to the amount of money that we actually have in our economy. So let's have a look at this graph right now. You see here a blue line down the bottom here. That blue line refers to what we call M0. M0 is the amount of cash and coins that we actually have in our economy. Now these cash and coins have all been created via two institutions in the UK. Coins via the Royal Mint and notes via the Bank of England. And they've actually come into existence what we call debt-free. There's no interest repayment. For example, the Bank of England could print off £10. They could sell that £10 to a bank in order to put money in their ATM cash machine. That money is then exchanged for £10 and there's no interest to be paid upon that £10. And that money from the Bank of England is actually transferred to the Treasury, and it's a form of income which the government use in order to spend as part of their budget for the benefit of the public. For the benefit of the public. So this money is all created completely debt-free. And that is the amount of money that the government actually creates. Right there. This second line here, this red line here, is what we call M4. M4 is the amount of money plus the amount of money that's actually in bank accounts through what we call sight deposits. So deposits actually in a bank account. M4 is significantly different to M0. The difference between M0 and M4 is all this money is created debt-free. All this money is created through loans. And I'll show you the process of exactly how that is created, and this gentleman touched upon the multiplier effect, which we're going to explore in a bit as well. But this money, all of this money, incurs interest repayments. Somebody borrows the money and it needs to be repaid, a higher amount of money needs to be repaid because interest has been incurred on that loan. Now you'll also notice that there's a green line. This green line right here is the total amount of consumer, me and you, and corporate companies borrowing. The amount of money that me, you, individuals and companies have borrowed. It does not include government borrowing, because government is far and away the largest borrower. But what you'll notice is that this here, this consumer and corporate debt, is higher up than M4, which means that there's less money in our economy than there is debt. Which means that in order to repay this money that doesn't actually exist, we need to continually take on more and more and more debt in order to pay off the old debt, because the money doesn't actually exist. Some of you might have heard someone going to prison at the moment for what we're calling a Ponzi scheme. A Ponzi scheme. Madoff has gone to prison. Well, it operates in a very similar way. The money doesn't actually exist to repay it, so you need to refinance, and while everything's going, while everyone are taking on more debt, it's okay. But when the debt actually stops, we start to notice a few problems. So this is it at the moment. Now, if you want to add government debt, you'll notice that this line is significantly higher than the actual amount of money that exists within our economy. So how does that process actually work? Well, let me show you. In order to do that, I need to just explore and tell you a little bit of history about the history of money and how we actually got here today. I'm going to go through the history of money in order to actually show you how the assumptions of modern economics actually come to be. So, our economy really originally was what we call a barter system. I'm sure you're all aware of this. A barter system means that if you wanted to buy a sheep, or you wanted a sheep, you had to exchange some kind of goods, like this gentleman was referring to, the value on goods and services. And you needed to run around and find someone that had a sheep, and perhaps you had some goats, and you exchanged your sheep for your goats, and you had to equally agree what you thought the value of those sheep and goats were. Well, you can imagine the limitations of such a system. Well, it probably could work quite well now we have the internet. But anyway, that's another point. So eventually, we all had to agree on something that we just agree has value. And the only thing that gives it that value is that everybody agrees that it has value. And so we created the first forms of money, and all sorts of things were created. But eventually, we agreed on these things called precious metals, gold and silver. For some reason, everybody agreed, and they trusted that if I exchanged my sheep for some gold, I trust that somebody else would actually value that gold, and then I can spend that gold and buy whatever I want. Well, I don't know why, you can't eat gold, but for some reason we decided that it was something that everybody values. So eventually, that was replaced, and I'm going to show you the transition with, instead of precious metals, we replaced it with these things called notes and coins. And more recently, that was replaced with electronic money. And now almost all of the money is created through the electronic format. It's in this transition that some assumptions were made, which we're going to explore today. So, let me tell you a little bit of a story. Early banking was created through what they call a goldsmith. As we said, people started to recognize that gold was the recognized medium of exchange that people trusted had value. So people wanted a safe place to store their gold. Now, a rich goldsmith decided to create a building and a safe storage place for that gold, and recognized that other people also wanted a safe storage place for their gold. And so that goldsmith would allow people to deposit their gold in their safe storage space. And in exchange for putting that gold, he would write a receipt, and that receipt would say that whoever holds this receipt can come to this, I guess, early form of bank, the goldsmith's storage space, and exchange that receipt for gold. Does that make sense? Everyone with us so far? Okay, well, as the goldsmith started to grow and grow the model, and more people started to deposit gold, he started to recognize that these receipts for gold actually started to become as good as having the gold itself. Because people said, I'll tell you what, I'll give you this receipt for gold, and you can go to the goldsmith and claim your gold. And as people started to grow more and more faith and trust in the system, these pieces of paper, these receipts for gold, became as good as gold itself. And eventually the goldsmith just sat there with a safe full of gold. Now, because the goldsmith was really the only one that actually knew how much gold was in the safe and no one was claiming it, the goldsmith started to realize that I could actually make loans with this gold, or I could lend, or I could invest this gold that no one's claiming. And I could write more receipts upon this gold. And that's exactly what the goldsmith did. They started to write more receipts upon the gold and lend out other people's gold. Now eventually people started to grow a little bit suspicious of why the goldsmith was making so much money just from a safe storage for gold. And they would talk amongst themselves, and eventually they'd all come along, they'd knock on the door and say, "What are you doing with our gold?" And the goldsmith would say, "Hold on, don't worry. I'll tell you what, I've lent out your gold. I know you're a bit skeptical, but here's some additional money for the privilege of your gold. And we'll share it. We can share the profits." And that's pretty much how most people think banking operates in the early forms, before we created these things called multiplier effects. Banking was born. The way banking is traditionally taught is that people leave deposits in a bank, and they encourage you to leave deposits by paying you interest. They then take that money and they lend it to someone else, a typical what they call a building society, how that would work. They would loan it, and as long as they charge a higher interest, it's basically profit sharing on the money. Does that make sense to everybody? As long as the interest was higher, you can pay a small amount of interest, loan it out, charge a higher interest, there's an amount of money you can make in between. Banking was born. Okay. Well, the goldsmith, again, started to recognize the success of this model and really started to recognize that, again, no one's claiming the gold. Everyone's happy for me to lend out this gold. What if I lent out more gold than there actually was in the safe? And that's exactly what the goldsmith did. And the goldsmith would lend out gold that doesn't actually exist, start to write receipts on gold that doesn't exist. The goldsmith would get richer and richer and richer. People would start to grow a bit suspicious. People would discuss with each other. And everybody would suddenly come and run onto the goldsmith's door and say, "Where's our gold?" And of course, if everybody wanted to claim their gold and claim their receipts, the gold doesn't actually exist. The business model was flawed. You might recognize such a process from November 2007, when everyone was queuing outside Northern Rock. The money wasn't actually there. It doesn't exist. So what actually happened is we started to recognize that there was a real scarcity of gold there was a real scarcity, and we started to recognize there was a real scarcity of silver. And we recognized that we needed loans in order to grow our economy and stimulate our economy and grow all these businesses and grow the businesses to the next level. So what actually happened is we made lending money backed by nothing a legal process, which was regulated. And as long as it's regulated correctly, then there wasn't too much of a problem unless everyone lost faith in the system and then the money doesn't actually exist or the gold doesn't exist. So in modern terms, what we actually created was a system called fractional reserve banking. Fractional reserve banking. Fractional reserve banking works by saying that here's, for example, if you deposit £100 into a bank account, then you need to leave a fraction of it on reserve. And the rest of it you can lend out. That was the system. So let's, for example, to highlight this, assume a 10% fractional reserve. And let's assume that £100 of real money has been created via the Bank of England and injected into the system and finds its way into a bank. So if that £100 finds its way into a bank, under a 10% fractional reserve, how much of that £100 are we going to hold on reserve? £10. Everyone crystal clear? Yeah? £10 will be held on reserves, and how much are we going to lend out? Absolutely. Okay. £90 would be loaned out. Now what would happen in a modern system is somebody would come along to that bank and request a loan. They would request a loan and say, well, I want to borrow £90 to buy a bike. And the bank would then agree the terms of that loan and say, right, fine, well, we'll lend you £90. How would you like it? And they transfer that £90 to their bank account. That gentleman who bought the bike would then go off and exchange that £90 for a bike with somebody else. Now, that gentleman that had the bike, that receives the £90, is more than likely to do what with that money? Deposit it into their bank account. Does that make sense? Yeah? So eventually, that £90, they deposit £90 and it finds its way back into a bank account. It doesn't matter if it's the same bank or a different bank. Now that bank then says, brand new money. We've got a new client. And that money would then it would actually go through the system, and under a if £90 is deposited, under a fractional reserve system, how much is that bank going to hold on reserve? £9. Everyone with us? And how much are they? So then they hold £9 on reserve, and they lend out how much? £81. Okay. So somebody comes along to the bank, and they say, well, I want to borrow £81. I'm a little bit short of money. I'd like to get an overdraft and pay off my accountancy bill. So they come along, the bank agrees, well, £81, fine. The gentleman takes that £81, is transferred into their bank account. Now this is newly money that's newly created. And that £81 is then spent on the accountancy bill. What does the accountant do with their money? Deposits it into their bank account. And what does the bank say? A new client, new money. They don't care where it came from, how it was created. It's just been transferred to their bank account. So that £81, how much do they hold on reserve? £8.10. How much do they lend out? Getting a bit complicated now. I thought we were in a room full of accountants. Excellent, 72.90. How many people had to get their mobile phone out and calculate that one? Okay, £72.90. Does everyone get the picture? Should we do this again and again and again? Because we could go around and eventually it would reach a limit. Okay. Well, what actually happens is the money circulates again and again and again under this regulated system of what they call fractional reserve banking. What the net result is that eventually you reach a limit whereby no more money can actually be created because it's ever smaller amount each time. Does that make sense? Okay. Well, the result is that £9 of debt will be created for every £1 the real £1, the real money. That's how the system actually works. The result of this is that 97% of money today is created through debt in such a way. Only 3% is completely debt-free, which is the contribution from our government or from the institutions, the Bank of England and the Royal Mint. So, is there any problem with this? Well, let's have a look. There's the system that we talked about. This is where the 97% comes through, in such a system whereby the money gets multiplied as a fraction of what was actually held on reserve. Here's the amount of money that's originally injected debt-free. Okay. Well, because there's more debt, the money is completely 100% unsustainable. It leads to continual and ever-increasing refinancing of either companies, individuals, or governments forever. Now, when we refinance in order to pay off the money that doesn't actually exist, every piece of debt incurs more interest. Every piece of debt incurs more interest. Now, we're going to discuss what the implications are later of that more interest. But every single piece of money, as more and more debt is created in order to pay off the old debt, more and more interest is paid, and that has implications that we're going to discuss in a bit. More debt means more interest. As this continues, more interest to be repaid. Okay. Well, the result is that because every economy operates in such a way, and we've exported the banking system, which was originally created in the UK, and it's exported to America, and that's been exported to developing countries, and that's been exported to all different countries across the world. The result is that everybody suffers from this lack of purchasing power. They don't have enough money in their economy to actually pay off the debt. So in order to actually, well, get to a more sustainable level, they need to find new money. What the result is that there's a couple of ways. We either create more debt and refinance, or we look to another economy in order to find this thing called debt-free money. Because what actually happens is that when you import and export, what happens is you produce goods in your economy, and you exchange those goods for money from whoever is the importer of them. Now, that money has been created as a debt in the way that we just explained. So if that money makes its way to another country, then that is debt-free money. That's debt-free money. And that provides a vital injection of money into that economy in order to make up some of the difference between debt and money. So what happens is the whole world fights to be an exporter. Everybody, all the economies that suffer from a lack of purchasing power, a lack of money in their economy, have to look to other economies in order to get a vital injection of debt-free money. Or they refinance, they take on more debt within their economy. Well, the net result is the third world debt has exponentially increased. The bank organizations that we talked about, like the World Bank and the International Monetary Fund, the World Bank tries to structure loans in other people's currencies. And those loans are tied loans, they're called, to actually imports and exports from the country of origin. And what actually happens is these third world countries are forced into such import and export activities, and the result on the country that created the money as debt is actually crippling for their whole economy. So they continually need to refinance, and that's why third world debt is 60% worse than when the International Monetary Fund actually was created. It's 60% worse, and the debt has been paid off many, many times over. But it's just gone on interest, and the debt has increased, which cripples economies. It really cripples them. So that's the net result, that everybody's fighting in this export country to get debt-free money in a system where almost all money is created through debt. That's one consequence. Okay, well, let's start to look. Well, you know, this may be a moral consequence, but let's actually start to look at some of the other consequences of such a system. In order to do that, we need to first explore the question, how did we get here in the first place? So in order for me to do that, I'm going to have to give you a brief history in economics. And I'm going to keep it as brief as I possibly can to give you exactly what I think you need to know in order to explore. And again, we've got to look at this in a macro scale. We've got to see things differently. We've got to look at the theories and actually analyze what these theories mean. So, firstly, such a system, as this gentleman kindly pointed out earlier, is what we call a multiplier effect. The assumptions of the multiplier effect are as follows. The government, or the Bank of England, or whatever you want to, however the country is structured, say that they have complete control over the supply of money, because the supply of money is vitally, vitally important. How money is supplied to economy is pretty much a cornerstone of every economic theory. The way that economics and the multiplier effect assumes is the following. That the government, they can inject an initial amount of money into the system. And they have complete control over that amount of money. When I say the government, this might be the Bank of England, which is independent of the government. But we're talking about how money is actually supplied. This amount is injected into the economy. And what happens through the magic of fractional reserve banking is ever smaller amount of loans are increased, and we have a velocity of money whereby every time the money circulates again and again and again, the amount of money gets smaller and smaller and smaller and smaller and smaller and smaller until eventually it reaches that tip where no new money can actually be created. And so if the government want to, or the Bank of England want to inject more money into the economy, then all they have to do is inject at the base, and then the multiplier will set itself in motion. Does that make sense to everybody? Everybody with me so far? Okay, excellent. So that's the assumptions of the multiplier. The only problem with the multiplier is that it doesn't exist. There is no such thing as a fractional reserve banking system. There's no requirement that you have to hold 10% of your money on reserve. That requirement ceased to exist a long time ago. It was replaced with a liquidity ratio and an asset liability ratio, which eventually said that 10% of your assets need to be held on reserve. Now, those assets could be anything. It could be government bonds. But the problem with government bonds is that they're part of the money creation process. In fact, it's reached the point right now where there's absolutely very, very little restrictions on this process. And this multiplier effect has made the foundation for almost all economic theories. So the only restriction that is actually in place right now is that 0.5% of the bank's money needs to be held with their bank account with the central bank. And that 0.5% is actually money that is created debt-free through cash and coins. So there's no restriction whatsoever. This assumption is not true. It doesn't imply, because the regulation is not there. Now, I'm not implying that it should be more regulation. I'm implying something quite different. Okay, so that's exactly why, for example, we can look in history and find out how this is so. And that's why you don't see the money going up and down. It exponentially increases, because it's completely lost control. There is no control. It's simply a function of debt. The more debt, the more money, which means the more growth. So that means in order to grow our economy, we need to figure out ways of getting institutions, governments, or companies in more debt. That's the only way to sustain the growth. But today the fractional reserve has shrunk to nothing, so the foundation of these theories is not something that actually exists. Okay, So let's show in a little bit of a historical perspective. Anyone been reading about the Great Depression of the 1930s? Anyone read that, started to look at that? Well, there's a lot of talk of the Great Depression and starting to look and seeing whether history is repeating itself. Let me explain how that actually worked. In the 1920s, because the multiplier effect actually broke down and more banks were created and more money was actually created through debt privately, we entered into, in the States, in what we call the Roaring Twenties. The Roaring Twenties, where people were taking on ever more debt and it was increasing and it was going back into the economy. Now, eventually, that debt reached a point where interest repayments got so high that nobody could afford to repay them. So eventually, on Black Thursday in 1929, it all came to a crumble and the market started to crash. And we started to enter, after that, into what we call the Great Depression, where there was a big contraction in the economy and the money suffered from an absolute lack of purchasing power. The medium of exchange, money, was not being provided. In fact, there was such a scarcity of money that it drove hundreds and thousands and millions of people into poverty, because less and less money was being created in such a situation, privately created, and the government weren't supplying the money that it actually needed. So what happened? Around about 1933, there was an economic advisor to the President Roosevelt. That economic advisor was this gentleman. Does anyone recognize who this is? Yep, John Maynard Keynes, one of the greatest economists of all time. I believe it was Cambridge University he came from. Well, John Maynard Keynes wrote a general theory. And in that general theory, he created and gave some advice to the president at the time, and said, in his general theory, that the way to stimulate the economy and to turn around the Great Depression is to take on government debt and inject the economy with government debt. And so the government, if they borrow more and more money and create a big public sector, they can stimulate the economy out of debt, out of the Great Depression. And so the government created these institutions like Fannie Mae and Freddie Mac that you might have heard about in the news, which basically was the birth of this securitization process where people borrowed money and it was sold to this government-sponsored enterprise. And then the government would guarantee the money, and more people would take on mortgages, which would stimulate that and inject the vital money that the economy needs. And also, if you start to employ people and create a big public sector, and then you can employ people and you can get out of these employment issues, and you can take on, the government can take on more and more debt. And as the government takes on more and more debt, it will stimulate the economy back out of a depression, which is exactly what it did. Now, John Maynard Keynes' general theory actually stated that when you get out of the depression and you start to reach prosperity, you need to save. And you need to pay off the national debt, and then you need to start saving for the next recession, because we're going to be in this boom and bust cycle where money is taken in and taken out. And so John Maynard Keynes said you need to save. Now, the government took on the theory, but as they think, circumstances meant that they could just never pay it off, because they were supplying and injecting the vital amount of money as debt. Where there was more debt, the money, they needed to continually refinance, and they just couldn't pay off this debt. And they thought it was because we entered into a war and all these things, and we needed a public sector and a pension and all this stuff. But to cut a long story short, the debt has exponentially increased ever since. And they're committed to paying it off, and it's not that they can't. It's not that they are thick or that there's circumstances. It's that it can't be paid off. Because imagine if you took away that amount of money, we'd be in a depression like we have never experienced before. And that is actually the lifeline of the economy. So, John Maynard Keynes created that. That's what we call the fiscal stimulus. The fiscal stimulus. Okay, Now, as we recognise the money supply is out of control, the multiplier effect doesn't work anymore, and the supply of money has exponentially increased ever since. And the government have taken on more and more debt in order to inject that amount of money. Then this gentleman came along. Anyone recognise this gentleman? Thank you, I heard that. Milton Friedman. Milton Friedman, one of the greatest economists of all time. Milton Friedman had a completely different theory of how the economy should be ran. Milton Friedman created what we call the free market. The free market. Now, Milton Friedman said that because the government, or the Bank of England, or the Federal Reserve, or whatever, doesn't actually have control of the money supply anymore, you can't directly control it. You need to indirectly control it through what we call interest rates, the cost of borrowing. Does that make sense? Everyone with me so far? They don't have control of the money anymore, so what we can do to gain control of the money is start to put up and down interest rates in order to control the cost of borrowing. And that was what we call monetarism. Monetarism, which is how our economy is run today. So, how does that actually work? Well, the economy is taking a turn. Because all money is injected via debt, in order to stimulate people back into taking on mortgages and taking on more debt and inject more money into the economy like we actually need, we need to decrease the cost of borrowing. So we put down interest rates until eventually people start running in and borrowing and taking out mortgages and refinancing their companies and doing everything that is required in order to take on more debt. And then what you do is the economy gradually starts to turn around, and eventually, as the economy grows prosperous, because everyone's taken on more debt and the economy has got the money that it actually needs, eventually this bogey, which all economists disagree on the causes of, called inflation, pops up. Inflation means that the price level starts to increase out of control. And so the only way in the modern economy can cope with such inflation is they decide to increase the cost of borrowing in order to suddenly send those people that took out the loans bankrupt. So they punish the people that got the economy back going again rather, by suddenly whacking up interest rates, and all of a sudden they can't afford it anymore. They can't afford to repay their interest, so people go bankrupt and properties get repossessed, and that controls this thing called inflation. So that's exactly how the modern economy is run. We put interest rates up and down because we don't have control of the money supply directly, by controlling it indirectly through the cost of borrowing. So if we want to stimulate the economy, we get everybody into debt, and then as inflation becomes a problem, we then punish the people that got the economy out by sending them bankrupt. That's how monetarism and our modern economy actually works. Boy, was Milton Friedman right. Interest rates slap the hell out of an economy, up and down, and we get this boom and bust effect. In fact, it works so well. It works much like a sledgehammer works at cutting a turvy. It whacks the economy up and down, up and down. And that's how we run it. I call it the sledgehammer effect. Monetarism. Okay. So, what suddenly happens when... This is where the discrepancy comes in. Is all economists disagree with the causes of inflation. Now, the traditional theories that created all these theories explain inflation as the following. Inflation is the cause, and this is the quantity theory of money. You've probably been taught it, the economists in the room, that the quantity theory of money states that inflation is caused by too much money chasing too few goods. Too much money chasing too few goods. So if you put loads of money out in the economy, then all of a sudden, because there's too much money chasing too few goods, people start to put their prices up. And that's the traditional explanation of inflation. Now, something that sounds more plausible to me is the following. Inflation, I'd say, is the exact opposite. The exact opposite. I would not say that the complaint in a modern economy is too much money. If you listen to the complaints in a modern economy, it's poverty amid plenty. Poverty amid plenty. And if you listen to the complaints from industry, they're not selling these goods and then suddenly they run out of goods and they're whacking their prices up because they're in a desperate rush to create more goods. They tend to be finding and trying everything that they can to find people to buy their goods. Investing in marketing strategies, advertising strategies, sales techniques, everything they could, because consumers are inundated with a choice of products. Does that sound like too much money chasing too few goods? I would say that the complaint is not that they run out of goods because there's too much money. I'd say they're trying to figure out any way they can to sell as many goods because they've got to pay these whacking great interest repayments on the debt that they took out in order to get their company going in the first place. And I would say that inflation is the exact opposite of how it is explained. A monetary reformer, and that's what I am, a monetary reformer would believe that inflation is a debt phenomenon. The more interest, the more prices go up in order to try and pay off that interest. Which is why inflation has only really been a problem since debt has been a problem. And that everybody is in a desperate struggle in order to pay off their debts because the economy's run off debt, that they need to continually increase their prices. Which explains stagflation, which is the concept of rising inflation during a recession. Because they can only keep their prices down for so long in order to pay off their debt, eventually it just reaches the point where you need to put your prices up in order to pay off your debt. And that's how inflation is explained through the eyes of a monetary reformer. Okay, so there's the discrepancies in the theory, and you have to choose which one you think is more plausible. So, that explains where we are right now in our economy. So let's just take a snapshot of exactly what we're doing in order to get out of this financial crisis. Well, what's happened is we've continually refinanced in order to pay off the money that doesn't exist. And so the national debt, the government, have sold more and more bonds and taken on more and more debt, and their debt is only going one way. They never manage to repay it. The same with companies. Companies are taking on ever and ever increasing debt. And consumers, me and you, it's reached the point now where rich and poor alike, 135% of our income is the amount of debt that we have. That means that there's 35% difference from our income to our debt, which means that we're assuming that we're all going to earn a lot more in the future. Okay, so that's 35%, and that is rich and poor people alike. So eventually, in order to continue growth, we have to figure out ways. So all the good people that can afford their debt might have repaid. Okay, all the good people that have paid all their debt, so what you have to do is try and find somebody else. And what happened in America is they went subprime. So they found people that couldn't afford to repay the debt because you need to continually inject money into the economy. So let's have a look. What are we doing right now? We recognize that people could not repay their interest anymore. Everyone's indebted up to their eyeballs. Student loans, everyone's indebted through their mortgages, corporate loans, and everything, and securitized loans and everything. Government cannot, they're possibly, see this is the irony. That when governments say they're committed, they can't afford it, all they need to do is create more money. in order to afford it. But there's consequences of that. But anyway, we'll start to look at that. So, what are we doing right now? We've realised that nobody can repay their interest. The debt has got so far that people can't. And it's the reason why today 3 people in an average household have to work just to afford what one person used to afford. Which is why the wife and the husband and the children have to all bring in income in order to pay off the mortgage when one person used to support the whole family. Okay, so what do? We realise that nobody can repay anymore. Interest has got out of control. People can't afford it. More and more money has been created through debt, and we need to sustain our economy. Well, people default, and when they default, that's a massive amount of money wiped out of the economy, and the economy starts to depress, as we are right now. So, first thing we do is action 1, monetarism. Everyone remember what monetarism? Controlling interest rates. What do we do with interest rates? We slap them down. All of a sudden, they reach 0%. Then what? We've lost our primary tool of control over the money supply, they say. But the money supply has actually been out of control for an awful long time. So we whack interest rates right down. Why do we whack interest rates? To stimulate consumer and corporate debt, so that we can buy more mortgages. We can now, great, okay, I can go and buy a mortgage now, I can buy a house. So that money is newly created money through a private sector. Newly created money through the private sector, injecting a vital lifeline into the economy. Also, consumers can borrow more and invest. That's action number 1. Now, the state's interest rates reach 0. We're at 0.5%. What happens when they go to 0? Uh-oh, we've got to figure something else out. Action 2, the fiscal stimulus. So, in order to inject more money into our economy, what did the government do? Increase the national debt. So they sell more bonds and they take on more debt and they incur ever more interest repayments. However, those interest repayments can never be paid because it's done through a Ponzi scheme, as we talked. They continually refinance to pay off, because the way that the national debt works is they promise to repay a higher amount in the future, and when it comes to repaying that higher amount in the future, they just they sell more bonds and they auction them off and do everything they can and increase the national debt, which is why it is exponentially increased. So the fiscal stimulus is the form of government bailouts and everything that we're seeing at the moment, increasing the national debt in order to inject more money into the economy because it's created through debt. Action step number 3. Here's the national debt in the UK, by the way. Does that look like something that we're trying to pay off? Does anyone know where that's going? That's 1.3 trillion. Quantitative easing is the next step that we're taking. Creating money as debt through the Bank of England. The Bank of England's creating it. Which just involves a computer transaction, by the way. You just simply press on the computer and it gets transferred. New money. In summary, what we're doing at the moment is anything that will increase debt. Anything. The government, if they're successful right now, they're trying to create the next property bubble. They're trying to create it again. They're so scared of prices going down, they're trying to get them up. But unfortunately, it's gone so far now that perhaps there is one last bubble. But our economy cannot take much more. It cannot take much more. But remember, more debt, more interest. This is 100% unsustainable in the infinite. 100% unsustainable. It's only a question of when we reform the way that we control money, or we supply money as a medium of exchange to our economy. Instead, we blame all the symptoms. It's these structured investment vehicles, it's these collateralized debt obligations, it's these subprime mortgages. Now, what the banks have been doing, yes, I can understand that it's very easy to get everyone angry at the greedy CEOs that have been taking ludicrous bonuses. And it's very easy to get angry at the reckless lending that's been going on. But the reality is, even though it's completely reckless, and there's definitely guided anger, they have been actually propping up an unsustainable economy. This debt has been sustaining our economy. Without it, we would have had the worst depression you could ever imagine. Imagine if we just went down to that amount of money. That would be poverty amid plenty. So we've just been refinancing, and so we can get angry at the symptoms, but more regulation and all these things that we're doing is trying to prop up the same. Now here's the funny thing. I'm not going to go into solutions today, but the solution is a lot simpler than you would actually imagine. It doesn't mean massively changing absolutely everything about our economy. But I don't know if everyone would agree with me today that money is far too an important thing to be created privately. And money is far too an important thing to be... if we engineered this system from scratch, would we really have mixed up the activities of profit-making loans with supplying our economy with a medium of exchange? Well, that's exactly what we do right now. 97% is created privately. The only thing that will get us out of this, or, well, we may be able to get out of this bubble, but the only thing that is completely sustainable and that we can go along and we can argue these free market arguments and all these things have gone back and forth, but it has to be built on sustainable economics. And sustainable economics means that we don't nationalize our banks, we nationalize our money. We nationalize our money. Now, please don't get me confused. I am not against debt. I am not against capitalism. I am not against all these things that you might be thinking right now. Quite simply, we need to well, the proposals, if you go to this website, www.simondixon.org, are an exact way of how we can actually gain control and a step-by-step guide of actually what we want to do. And this is what I spend 1/3, 2/3 of my time explaining to people. And if anybody is interested in finding out exactly, because it does get quite technical, but it does not involve mass changes. It doesn't involve eliminating all this debt or anything like that. There is changes that we can make. If anyone's interested in those, then have a look at simondixon.org, and I publish all these things that we're talking about in further detail. And you can contact me, and if anyone does have any feedback or anything that they want to discuss, then my hobby at 2 in the morning is replying to things on my blog. Okay. That's everything that I wanted to discuss. Now, I open the floor to questions. And if anyone wants to ask any questions, then I'm happy to take those right now. Has anyone got any questions? Yes. Can I ask your name?
I'm called Charles.
Charles.
Yes.
Charles.
Charles, yeah. I'm
Charles.
MBA financial services.
Okay.
You talked about the world fighting for more debt through export. Does that explain the reason I've been hearing that when countries are in a depression, they want to attack other countries or create war?
Mm-hmm.
So that is that the explanation that they want to...
If you want to read into this, you could pretty much start explaining away most problems in our world through this. Third world debt, poverty, wars. You can start explaining away everything. If you want to look at theories of how this links into those, there's plenty of them written. So you're exactly right. I do agree with you on that. Yeah. Yes.
At the moment, governments have lost control of money, as you said, okay? And it seems like...
For decades now.
Exactly.
Yeah.
That's the only way we will not keep on going into this cycle.
Mm-hmm.
What would you recommend as, not a one solution, but what would you recommend as the way government should go about to further regain control?
Okay. Money is a human creation. Is a human creation. Should there ever be a scarcity of a human creation? Let's just look at the assumptions, and we need to look at things outside of the box. Why should there be a third world country? which has all the people willing to work, all the resources that they actually need, and all the businesses that are willing to work their way out of poverty, and all the food and everything that they actually need not to be in poverty. Yet because of this, the way that we've structured money, they have to actually take things of real value, food, out of their country and exchange it for this thing called money, which is complete opposite of how it should be. Why should that be if money is a human creation? Money should be created and provided completely debt-free, completely debt-free. If you would like to know a way of actually doing that, for example, the Bank of England, independent of the government, so the government just doesn't print money and we end up with the Zimbabwe situation, could actually decide to how much, under set monetary policy goals, under a democracy where everybody votes, to directly control the money supply by either transferring it to the Treasury and the government spend it into the economy debt-free. That means that they would be responsible for creating a massive amount more of money, and the banks, it would be made illegal, like the assumptions of things like Islamic banking, where they have to operate under 100% fractional reserve, which means that they can't create money. The way that a bank would work exactly the same. It would encourage people to deposit money with them and then lend that money out. But they can't create money. That is an activity which should only be done for the benefit of the public. For the benefit of the public. I know it's a big amount to go through, but I'm more than happy to point you in the direction of exactly points of the solution, because it's more than I wanted to cover today, if that makes sense. But does that give you a little taster of how it could actually be done? Imagine the Bank of England decided how much money we need, how much median of exchange our economy needs. And rather than injecting it in as debt through the private sector, it transfers it to the Treasury. The Treasury spends it for the benefit of the public. That would mean that they could use that money and they could profit from it for the benefit of the public, pay off the national debt or whatever they need to do. And then the money would be supplied completely publicly rather than privately. Now, because it depends on your belief in inflation, but because that doesn't incur interest repayments like the current system, it might be non-inflationary, depending on what people's beliefs of inflation are.
Isn't that what the US is currently trying to do with all these initiatives?
No, the government, the US are creating money as debt. All this is funded through bonds, which they're selling off, which they need to repay plus interest. And the Bank of England is creating money out of thin air in order to lend money to the government, and that needs to be repaid plus interest. The same system. We're trying to continue the same system, prop it up again. We're dealing with the symptoms, not the disease. Yes?
My question is slightly different from others. Because I was reading an article by ACCA discussing in length the CDOs, the securitization and everything. And from that article, I was made to understand that the bankers, they have seen this ahead. Just like when you are talking of Freddie Mac and Freddie Neal and all that. It got to a point that they were carrying assets, mortgages, that is more than the real, that is less than the market value. So I would, to the extent that's fine, the government forced the bank to be giving out loans and all that, and credit to people, fine, the government created it, but before the bubble burst now, the bank had seen it, and you remember, you know that it got to a point when the interbank lending rate, between the interbank lending, most banks, they were not lending to each other because they knew that most of these banks, they were carrying assets that is worthless in their
Can we reframe slightly? Like, it's worthless, yeah? But what's changed?
Sorry, one minute again.
Yeah,
Just
okay.
for, a recent example of Northern Rock that is willing to lend 125% of your mortgage of the worth of your mortgage, knowing fully well that in the real market now, mortgage prices are falling 125%.
Mm.
You know, don't you think,
Mm.
to the extent that we can blame it on the government, but bankers are people like us, intellectuals, that have seen this ahead before the bubble burst now.
Well, I would say most bankers haven't seen this because very few people actually discuss. You know, bankers are not economists. Bankers are there to do their job, and their job is to earn bonus by taking out deals. Yeah.
That is what really crumbled the economy, because just like the hedge funds.
Okay. No. Well, can I just say something? If that didn't occur, then the government would have had to take on that debt, or we would have had to take on that debt, or whatever the debt had to continue in order to stimulate the economy, in order to maintain the same system. So although you're quite right, you're very right, there's been really reckless things, but it's forced. We're forced into debt. We're forced to refinance because we need to continue these growth figures. And I'm not blaming the government. What the government is doing is based on orthodox economic theories and doing exactly what they should do based on orthodox economics theories. However, I'm questioning those theories. And this is, until we question these theories, we won't come up with a better result. But what will happen, guaranteed, is that all that's happening right now is because all that debt's, nothing's changed. We're all here. We all want to go to university. We all want to get money to go to university. We all want to live in a house. We all want to buy a house, and everybody's still consuming. But something's changed whereby we can't actually get that money or spend that money. What's actually changed? We need to question these things. Everything's real is still there. Nothing's changed apart from this concept right now. And so what actually happens is, as a result of this system, somebody has to take on the debt in order to maintain growth. And so what the banks have done is they've maintained economic growth. Granted, reckless, but what's happening now is that debt is being redistributed to national debt as the government bail out. And so that national debt has to be taken on. So someone has to take it on, and eventually interest repayments get too high, the economy collapses. This is 100% inevitable, predictable, guaranteed. It will happen again until we reform the way that money is supplied to our economy. It's a guarantee. No matter what regulation we take, we may turn around another bubble, but it's still the same. These facts don't actually change. And the problem is what is it? Everybody's working to a 5-year time frame for the next election.
So what is your proposal? What do you see? How do you see us coming out of this?
Yeah.
Banking industry?
Well, monetary reform has to happen now or later. It's inevitable. It has to happen. So we have to nationalise our money, not our banks. Our banks, it doesn't matter. If we nationalise our banks, that's just the same system. It doesn't matter whether the government's creating money as debt or private individuals are creating money as debt. Money should not be created as debt.
So, invariably, what you are saying is that the government should be the one to decide the amount of money we need in our economy.
Well, I wouldn't recommend the government, because we'll end up in a situation like Zimbabwe, where for political reasons, they're creating more and more money. And then you end up with hyperinflation or whatever it may be, depending on your interpretation of inflation. The Bank of England, under a democracy, should have monetary goals, and they're solely responsible for the amount of money that we have in our economy. And rather than doing it indirectly, they do it directly. It means that it would be much easier to control inflation. It would be much easier to have them completely accountable. They could directly control the amount of money rather than giving it to the banks to create money privately, which makes a tremendous amount of profit, which isn't for the benefit of the public. Yeah?
Don't you think that will negate the principle or the benefit of capitalism?
No, I believe that the free market can still operate under such a system. All the government are doing is or the Bank of England are providing a medium of exchange for capitalism to thrive. Capitalism cannot thrive under this system because it's unsustainable. It's unsustainable. Yeah.
You just explained the way how the money is being created around the world, social life.
Yeah.
Since it started, first of all, exchange of goods, and after that to gold. and now to the paper.
Mm-hmm.
Don't you think that in all these phases it came to a point with all these depressions and then probably the human being needs to think for another way of exchanging rather than sticking this kind of paper anymore?
I completely agree with you. Completely agree with you.
Because it's most of the time what we do, we kind of transfer money, everything we do that through the internet. I mean, we're talking about the mobile phone now. So we don't see that 20,000. I don't think anyone, had like 20,000 or 100,000 pounds on the kind of bag and going to.
Can I ask everyone a question just upon that?
Yeah.
Has everyone in the room got a bank account? Raise your hand if you've got a bank account. Has the bank ever called you and said, I notice you've got £5,000 in your account of money. Do you mind if I lend that out to somebody else? No. That's because they create money. It's privately created in this way. So when you take out a loan, that's brand new money that's created into existence through debt plus interest, which is refinancing the economy. The amount of money is a function of how much debt we'll actually take on. Hence, collateralized debt obligations, mortgages, structured investment vehicles, national debt, every innovation that we can come up to increase debt. Yeah? Okay, yes, I'm going to take the last question now.
Is I don't see anywhere on the website where you propose a solution to this, or really any of the other links that are on the website.
Okay, I will put a post up there.
Some people asking for a proposal, but there's not really anything up there that has any solutions.
Okay, I will put a post up there that will be there in the coming weeks. I took it off because I wanted to readjust something, because I met one of the great monetary reformers who actually put together a little proposal which I want to put up there in conjunction with this as well.
Do any of the other websites have any proposals that, because it seems like this is a pretty big thing. I mean, everybody, all the websites I read on there all point to the problem, but none of them say anything about it.
No. Monetary reform is not that well discussed, and at the G20 meeting that's coming up in London, I propose that it should be #1 on the agenda. And if you want to get involved in discussing these things, then I can point you in the right direction if you need some details on the website. Okay? Okay, final question, yeah.
You talk about the government has to nationalize the money and not the banks. What do you mean by nationalize the money?
Okay, so the government needs to take control of the money and inject it into the economy debt-free. And they need to provide a medium of exchange rather than it be done privately, as 90%, 97% of the money is at the moment. That does not involve banks. It involves a system of providing that medium of exchange. In fact, Abraham Lincoln was a monetary reformer. And Abraham Lincoln implemented monetary reform during the Civil War, where they created a new form of money and spent it into the economy debt-free. And #1 on the agenda of Abraham Lincoln was monetary reform. And he put together a proposal for how to do that in the States. And unfortunately, he was assassinated before it could be done in peacetime. But there's many great, Thomas Jefferson, there's many great monetary reformers as you start to research this subject. Yeah. Okay, well, thank you very much. I've really enjoyed the talk today. It's been some great questions. And I'm going to hang around for a bit. You've been a great audience, and I've enjoyed the talk today. Thank you.